Hey guys, Zaman
And Christina
from Our Rich Journey. Today we are talking about poor investment decisions. And these decisions are usually disguised as good investment moves, when in fact they are absolutely counter to that. And so many people are making them on a daily basis that we want to take this time to point them out and save you some money.
So in this video, we are going to be talking about some of the really bad investment decisions that people make. But not only that, we're going to talk about some alternative solutions that people can do instead of making these investment choices. So the first really bad decision that people make when it comes to investing is investing in whole life insurance.
Now, whole life insurance has always been one of those things that has been controversial when we talk about it as an investment. There are people that are adamant about whole life insurance being the all-inclusive and best insurance for people to make, especially for families to make. They will make the argument that it is an opportunity to be your own bank, to borrow against a policy, to build equity. You will hear all of these arguments that are pro whole life insurance. But as you begin to dig a little deeper, a lot of the issues that you will find is that these policies are so complex, cumbersome, and high in fees that they are actually a drag on your wealth. And I'll give you an example of what I mean. If you look at a whole life insurance policy, and this is very typical of most of them, you usually have to put a great deal of money into them every single month. And you have to continue to do this essentially for as long as you have the policy. And it is not until the policy reaches a certain point where you are able to borrow from it, get payments from it, or benefit from some of the things that these salesmen tell you that you can benefit from. The other idea with whole life insurance policies is that you are getting to reap two benefits. You are getting life insurance and you are getting an investment. Let's talk about the investment piece first. You will find that the investment piece of these policies doesn't even keep up with the returns of the S&P 500. And a lot of this has to deal with the fees that the insurance companies are charging you. And now let's talk about the life insurance piece. Life insurance is very, very important, but mixing it with an investment, that's the issue that we have. When most people, if they are interested in life insurance, what they should do is just buy term insurance. And so instead of paying this high cost for whole life insurance, if you buy term and then take the difference in price between term and whole life, take that difference and invest it in the stock market, you will find that your money will do a lot better.
The next bad investment decision that people have is having too much cash. Now, there is definitely a part of cash that you should have allocated for savings, but there's a difference between saving and investing. When you are holding so much cash unnecessarily on the side and you're not investing in it, that cash is not keeping up with the rate of inflation and you are not able to grow your wealth.
And this is a very important distinction to make because when you put money in a savings account, when you are holding cash, that cash should be set aside for a short-term goal. Like you are planning on buying a car in a couple of years or maybe a down payment on a house in a couple of years. But you invest your money to grow wealth over the long run. So for example, you invest for financial independence. You invest for retirement. You invest in things that you will need to build wealth in order to obtain. And when you invest, you have the power of compound interest exponentially growing your money. The average return of the stock market, for example, is 8 to 10% annually. So by investing your money is compounding at that rate. Now, on the other hand, when you save, you are not getting that same type of exponentially high compounding return. The next bad investment decisions people are making is listening to the advice from a financial advisor and they do not understand that advice. Now, we don't have anything against financial advisors, but we always say do your own research before you go talk to a financial advisor. At least get your financial literacy up. And so that when you go to the financial advisor, you can keep up with the conversation. But if at any time you're having this conversation and there is something that they are recommending you invest in that you don't understand, if you make that investment, that is a bad investment decision.
So, if you have been following our journey, you know that we did all of our investments ourselves. We did not use a financial advisor, and we think that people can create their own investment plan. It can be so simple that you don't actually need a financial advisor. But for those people that are using a financial advisor, it's really important to understand what they are investing for you, even if you're not doing it yourself.
And we're telling you all this because so many people are being taken advantage of by financial advisors, either through the fees, either through conflicts of interest that the financial advisor has, and they are putting you in things that they are getting a greater commission from. There are so many things. It becomes a slippery slope when we're talking about investing with the financial advisor and not understanding what is going on. The next bad investment decision people are making is buying a bigger house. I mean, I can understand that sometimes you feel like you need more room. Maybe you need more bedrooms because your family is growing. But to buy a bigger house just for buying a bigger house sake, well, that comes along with some issues in our mind. You know, when people are buying bigger houses, it means higher taxes, more maintenance costs, and tying up your capital. Oh, this is a big part. Usually, when people go for that bigger house, they have to come out of their pocket with more money. And this is money that you could be putting to work in other areas to diversify your portfolio, to diversify your assets. So you have to really be careful about wanting to buy a bigger house.
Now, another thing that's really interesting to me about buying a bigger house is that if you do this, you tend to have to buy more furniture to fill all of these rooms that you may not even necessarily use. There's so many additional costs that come with buying a larger home. So when you're thinking about investing in real estate, even when it's your primary residence, you should be thinking about it as an investment and what is the best investment for you as a form to grow your money.
The next bad investment decision is buying timeshares. Now, Christina and I, we have actually gone to several timeshare presentations. And for us, it's always a fun thing to do. We love how the salesmen work their magic. We believe that, in fact, they put actors in the audience to get everyone else that is not the actor excited about the timeshare. Now, timeshares are really sold as an affordable way to take an annual vacation. They really make the salesmanship that you do want to go on vacations. You do love your family, don't you? So you should get a timeshare. But what they don't tell you is that these timeshares are a depreciating asset. And on top of that, the maintenance costs involved in maintaining these timeshares can be significant and can continue to go up in price. We have seen people that have bought timeshares realize that they weren't using them, and then those people tried to go and resell those timeshares, and they have struggled to do that.
So the last bad investment decision that you can make is not investing in your own financial literacy. And I think this can be really hard for people because investing can seem very difficult. And so anytime there's an investment opportunity, people look the other way. If there's a class or there's a good book that you can read on investing, it's just easier not to deal with it.
And there's also something else that's going on with people when it comes to financial literacy. They think that it's going to be boring. They don't want to invest the time in learning this stuff because they think, I don't want to learn it. It's not exciting. I'd rather spend my time listening to music or watching Netflix shows or all these other things. And some financial literacy can be boring, but some of it can be really exciting. And what you need to do is find the financial literacy that speaks to you, that you get excited about listening to. And what you'll find is that the more you learn about it, the world around you actually becomes more interesting. It's something that we have found as we have gotten deeper into our financial literacy, especially when it comes to studying the economics of things. And so we encourage anyone that has not started to take their financial literacy seriously to give it a second thought.
So those are the poor investment decisions that people are making. Hopefully, if you are making any of those, you can really evaluate your situation and see how maybe you can tweak some things so that you're more aligned with making better investment decisions. And of course, if you like this video, make sure you give us a thumbs up, subscribe to our channel, and join the journey.